Hello, everyone. We'd like to welcome you to Riveron's Ask the Experts webinar recap of the 2021 AICPA and CIMA Conference on current SEC and PCAOB developments. Your presenters today will be Zach McGinnis, a Managing Director specializing in capital markets transactions from Houston, Jason Johnston, a Director in our Atlanta office with deep experience in accounting operations and capital markets, and Jen Braden, a Senior Manager in our Chicago office who specializes in technical accounting. I'm Patrick Garrett, a Managing Director in our Dallas office, and I'll be our moderator today. Some key reminders before we get to the content. Please turn off your cell phones during the presentation for the enjoyment of your fellow patrons. Just kidding. This is a webinar. Leave your cell phones on, let your dog bark, your kids cry, whatever you got to do. But seriously, do please pay attention to the polling questions. There will be 4 polling questions throughout. You'll need to respond to the polling questions in order to obtain CPE credit. During the webinar, if you have questions, feel free to submit them through the text feature within Zoom. After the webinar has completed, it'll take about 2 weeks, and you'll get a webinar evaluation form and CPE certificate to the email address you registered with. A rewatch of the webinar is not eligible for CPE. And after the webinar, you'll receive an email with access to this deck, a recording of the webinar, the ability to join our mailing list to receive future webinar invites, and presenter contact information for any questions you might have that you want to reach out directly to them. With that, let's go to today's agenda. To set the stage a little bit, the AICPA and CIMA Conference on the current PCAOB and SEC developments, or the conference, is typically one of the more noteworthy conferences during the year. The SEC and FASB really give insight into what issues they are consistently seeing and their perspective on forward-looking trends. If you've ever been quoted guidance from an SEC speech, that speech was likely made at this conference. This year's conference had a particular emphasis on the accounting industry workforce as a whole. The conference started with former AICPA Chair Tracy Golden highlighting the battle to draw talent to the profession all the way to the high school level, while specific panels highlighted the need for continued progress on diversity and inclusion. Panelists highlighted that the accounting profession of tomorrow will not only need to be more diverse, but will have to creatively solution new investor reporting demands more effectively, more efficiently, which will likely involve an increased need for technology skill sets. While we've chosen to focus today's agenda on items that we expect to impact preparers in the near term, we did feel that those themes from a broader big picture were worth noting. And with that in mind, we've broken down today's agenda into 3 sections: an overview of SEC matters, and the update on accounting issues discussed from the FASB and the Office of the Chief Accountant, and other hot topics such as ESG reporting and auditor independence. And now to our first polling question. We want to get a sense of where our audience is in their reporting requirements. The polling question is, my company is currently a recurring registered filer with the SEC, a registered filer as an EGC, in the middle of the registration process, considering an IPO next year, or none of the above. Zach, as people respond to the poll, what kinds of SEC reporting issues are your clients finding the most challenging as they prepare for their year-end reporting cycle?
Yeah, thanks, Patrick, and thanks everybody for joining today. Happy to be here. What we're seeing in practice with a lot of our clients is around basis of presentation matters and SX 305 matters for relief. We'll talk about this a little bit more in some subsequent slides, but when it comes to significant acquisitions, particularly for those clients that are transaction heavy, applying the new rules, which we'll go through here in a little bit, and getting through the process to prepare standalone financials for those significant acquirees is quite challenging and does cause deal delays quite a bit. So something to think about there when looking at a public offering and all the financial reporting components that go with it.
Great. So looking at our poll, we've got a lot of people that are already regular recurring filers with the SEC, and a handful considering an IPO in the next year, and then a lot of other folks that have just joined to listen in. So with that, let's go on into the SEC update. Zach, turn it over to you.
Sounds good. So the first section we want to go through here is materiality assessment. So materiality was something that was discussed as a major hot topic at this year's conference in December. One thing the SEC wanted to make sure to highlight was that the guidance hasn't changed, but rather, a set of observations by the SEC and looking at filings, looking at disclosures around what we'll call big R and little r restatements, and the trends associated with that. So just as a refresher, SAB 99 is the prevailing guidance when looking at prior period errors in previously issued financial statements. So that's still kind of the accounting guidance infrastructure, if you will. And objectivity, obviously, in this topic was something that the SEC really encouraged preparers to take a stance on, is really looking at it from an objective standpoint, even though the consequences for a restatement are obviously not always looked at in a positive way. But when determining whether any prior period errors are, big R or little r, they really encourage preparers to look at things from an objective perspective. From a trend standpoint, the SEC noted during the conference that they're seeing an increasing number of little r revisions compared to prior years. And just to clarify, a big R restatement is when the company corrects the error in the current period as well as refiles all previously issued financial statements. Let's say it's a 10K or 10Q or S1. Back in the day, before 2021, big R's made up a significant portion of restatement matters. And in 2021, in recent periods, little r's have now made up the largest portion. So I think that trend was looked at by the SEC as, if there is a quantitative material misstatement in the financial statements, it's very challenging for qualitative factors to overcome that quantitative error. So again, not a change in guidance, but rather a pretty significant change in how companies are looking at these errors from a little r or big R perspective. And then, our firm's point of view here is, document early and often. Typically, there's a SAB 99 memo, associated with looking at these matters, and then consultation with the auditor's national office. And if needed, the SEC is something that you want to tackle early and often. So from a look back on the 2020 rule changes, so this is an area it's kind of an exciting time to be alive. And in my career, the SEC generally doesn't change their rules all that often. Obviously, the FASB does quite often change and implement new accounting guidance, but the SEC not so much. But in 2020, there were two pretty major changes that impacted our clients. The first one we'll talk about here is with respect to amendments to MD&A, selected financial data, and the other matters here in the table. And what the SEC wanted to do at the conference in December was to provide a look back of, in 2021, what they observed financial statement preparers, the impact on those 2020 rules in their 2021 financial statements. And what we heard is it's still a little early to tell, as a lot of these changes are required to be implemented by preparers in their 2021 Form 10K that will be filed here in early 22. For us as a firm, a couple of these areas we've seen our clients really benefit from a timeline and complexity standpoint, one being the third item here, selected quarterly financial data. So back in the day, the public companies in their K, for example, would have to show each quarter for the last 8 quarters, or 2 years, if you will, of selected financial data under SK 302A. And now that's not required. So this is an area not necessarily in the going public IPO process, but rather for existing public companies, this disclosure was pretty burdensome. And so this is an area where we've seen a big time saver, if you will, for our clients. And the second one is the first line item on the table here, contractual obligations. The SEC made a point to remind preparers that even though the table The disclosure isn't required in a tabular format anymore. Preparers still have an obligation to disclose material future cash requirements or contractual obligations in MD&A, just not necessarily in the table there. So more of a presentational change, but not necessarily a major relief of disclosure requirements. And then the other items are relatively, for us as a firm and our clients, not a huge adoption or huge change there. So. The second point, to do a look back or recap on the SEC at the conference in December, had a few sessions on the changes to SX 305. So what I was mentioning earlier, if a company has a significant acquisition, let's say in 2021, or a company's going public and they have a over 50% significant and probable acquisition coming up, there's a requirement to show standalone audited financial statements of that target company if it exceeds certain quantitative tests. And just as a reminder, the income test, the investment test, and the asset test are still the three major tests, but the way that these are applied and defined did change in 2020. And so the first example here is on the top left. The income test now has a revenue component. So this was a really interesting change in an area that we saw a lot of impact with our clients, to where if the revenue component results in 5% significance and the pre-tax income component results in 35% significance, then the preparer would not be required to show 305s as they didn't exceed the lower of the two. So this is definitely a major change from the rules that have been in existence for many decades with the SEC. The second major change is around the investment test. So the SEC in the 2020 rule changes came up with a new glossary term called the aggregate worldwide market value, or AWMV, and that is the denominator that's used in the investment test for public companies, right? For private companies, we still look to total assets. And the SEC in 2021, as they were looking at preparers and filings associated with the investment test, they found that there was some confusion as to how preparers define AWMV. And so the SEC reminded folks at the conference that you should look to voting, publicly traded and voting units, as well as non-voting. So certain preparers included units that were not traded on public exchange, and convertible preferreds and other types of items that should be excluded from the AWMV definition. So just a point there by the SEC. With respect to pro formas, a couple things here. As we all know, in 2020, the SEC is now allowing preparers to include synergies in Article 11 SEC pro formas, but not in all cases did preparers also include dyssynergies, if you will. So, call it taking the good guys and the bad guys. The SEC reminded preparers to take both and not just the synergistic aspects of the business combination. So, and then the asset test, no changes there. So we're still applying the old rules that have been around for quite some time there. And our point of view as a firm is very similar. Document early often, do the calculations for 305 and consult the Auditor's National Office, and then the SEC if needed through a pre-clearance letter.
Zach, have you seen many companies benefit from the 2020 income test changes, where companies can take the lower of the revenue or pre-tax income?
Absolutely. It's actually saved some of our clients and saved them, 1 to 2 months of deal timeline, where it would have, the IPO, for example, would have been delayed by a significant period of time if that revenue component wasn't in the income test, like it wasn't back in the day. So for sure, it's definitely a well-received change. And all this is kind of wrapped into higher quality financial reporting. But generally, our clients look at these changes as, the SEC being friendlier and gentler with respect to financial reporting requirements than they were back in the day. So
that's definitely great to hear.
Yeah. From a SEC waiver letter trend standpoint, this is a really exciting session at the conference in December every year as to the SEC's view on what preparers are seeking relief from. from a financial reporting standpoint. So a couple of highlights here, entities with differing year ends, particularly in a 305 or transaction heavy company. Let's say a US domestic registrant with a 12/31 year end acquired a Australian company with a 6/30 year end. The SEC saw an increase in preparers seeking relief from the traditional 90-day rule, where the acquirer and acquiree need to have financial reporting periods, within a 90-day window. The second one around the use of pro forma financial information and significance tests. This is an area where, let's say in a de-SPAC situation, where using the 12/31, historical financial statement, the actual audited financial statement numbers yields a confusing or overly time-consuming result versus using pro forma financial statement, pro forma financial information, let's say in the denominator of the asset test or income test, yields a more helpful and meaningful result, and will save and has been known to save preparers some time, as they likely would be relieved of those 305 reporting requirements. The concept of substitution versus waiver was talked about quite a bit as well at the conference, where if a preparer is seeking relief, let's say they're filing an S1 today and they need to show, let's say 19, 20, and then ultimately 21, the SEC reminded preparers that that instead of seeking full relief, let's say from 2019, the earlier of those two annual periods, but rather substitute that request with a more recent interim period, would create a situation where the SEC would more likely potentially accept that waiver request rather than just asking for complete exclusion of all those periods. So 2 years versus one, I think we're all well familiar with the 2-year requirement, and the pain that a lot of our clients go through in preparing that earlier of 2 years when that information is not readily available, or if it's overly burdensome or costly to prepare that information. This is an area where a lot of preparers requested relief to just show 1 year versus 2. And then it wouldn't be a good conference without the discussion of non-GAAP measures. So again, no major rule changes here in 2021, but rather an emphasis of labeling and prominence. So the SEC continues to see preparers that label recurring items as non-recurring in their, let's say, add backs to get to their non-GAAP measure, let's say adjusted EBITDA. And so the labeling of that can be confusing if that is there, if that item has occurred in the last 2 years or is expected to occur in the future 2 years. And then prominence, we all like to put our adjusted EBITDA measures for marketing purposes early in the registration statement, or Form 10K or 10Q. And the SEC continues to remind preparers that, if you do that, that's fine, but also needs to show the related GAAP measure in the same breath, so to speak. Okay. Also, it wouldn't be a fun conference without mentioning SPACs. Clearly, SPACs over the last 18 months have become one of the preferred vehicles to access the public capital markets. And in fact, Q1 of 22, as we head into this first quarter of this year, the first birthday of peak SPAC will be reached. As you know, Q1 of 21 saw more volume, SPAC IPO volume, than the entire year of 2020, the year before it. So as we go into the first birthday of peak SPAC, we as a firm believe that 2022 will be a strong year for de-SPACing transactions, assuming not a significant amount of redemptions in that model. So a few things to highlight that if you're involved with SPACs this year, were very disruptive was the change of presentation of warrants from equity to liability, and the balance sheet reclassification more recently in October from permanent equity to temporary equity are probably two of the more disruptive, not necessarily accounting changes, but interpretive guidance that came from the staff there. So just as a reminder for folks that are loosely related to SPACs. Direct listings was mentioned briefly, but just as a reminder, direct listing is an alternative vehicle to a traditional IPO where companies can actually raise capital without an underwriter, which obviously poses certain legal risks and other types of risks. But again, in the world that we live in now of access to public capital isn't just a traditional IPO, isn't just SPACs, but also a direct listing is now available. And so the SEC talked about the lower volume, obviously compared to SPACs of direct listings, but the expectation that going forward, certain companies will need to access the public capital markets with these different types of vehicles there. So. And then last but not least, before I hand it back to Patrick for the next section, is around segment reporting and expense-related disclosures. Again, it would not be a fun conference without talking about segments, at least for a little bit. The SEC, raised a few points of, call it, scrutiny around, companies that have one reportable segment, the continued focus on why that is, what information is available to the chief operating decision maker. And in certain cases, the SEC has requested the CODM package from the company to support its one segment. So that's an area that they're looking at more. And the SEC reminds you, preparers, that when they look at a K or an S1 or a Q in assessing the appropriateness of the segment accounting policy, that they'll look at outside information as well and how it impacts the segment policy itself. So the website, public releases by the CEO, marketing materials, and those types of things, and how the impact to segments plays in there. And then expanded disclosures. So the SEC continues to expect preparers to show more expanded disclosures around fixed versus variable expenses and recurring versus non-recurring. So that's an area that they're going to continue to look at, that more disaggregated level of detail, so that investors and readers of the financial statements can see the company through the eyes of management. And I believe if we keep going. Yep, polling question 2. I guess I'll give the mic back to Patrick.
Great, thanks, Zach. And now polling question 2. Which accounting standard transition do you expect to focus on in 2022? ASC 842 leases, ASC 326 current expected credit losses, ASC 848 reference rate reform, or the LIBOR transition, or do you expect to continue to focus on other accounting issues like RevRec, goodwill impairments, stock comp, etc.? So as the audience responds, Jen, wanted to get your thoughts, as we've seen a lot of big standards issued in the past 5 years. Did the FASB give any indication of what to expect from standard setting in the near term?
Thanks, Patrick. There aren't any major new standards on the horizon, but the FASB did spend a significant amount of time this year surveying registrants on the ASC 606 and ASC 842 implementation process, which resulted in changes to the current existing accounting models that we will cover in detail in the subsequent slides. The FASB is also focusing on completing various projects in place to implement improvements and clarifications to existing standards, such as accounting for goodwill, CECL, reference rate reform, and segment reporting.
Great. And it looks like we're getting the results, and it looks like there's a split with some focus on leases and then a continued focus on the the oldies but the goodies, and continuing the regular old accounting standards that continue to be issues. And with that, Jen, why don't you take us into the accounting update?
Thanks, Patrick. In regards to the accounting update, the 2 sections we're going to cover include the FASB current technical and forward-looking agenda in regards to standard setting, in addition to insights gained through the OCA or Office of Chief Accountant speeches. The first topic that I'd like to cover is the FASB standard setting agenda, including recently issued and upcoming ASUs. Related to the new lease standard, the FASB recently issued ASU 2021-05 in July of this year, which amended the new lease guidance so that lessors are no longer required to recognize a selling loss upon commencement of a lease with variable lease payments that prior to the amendment would have been classified as a sales type or direct financing lease. Under the new guidance, a lessor must classify as an operating lease any lease that would otherwise be classified as a sales type or direct financing lease, and that would result in the recognition of a selling loss at lease commencement, provided that the lease includes variable lease payments that do not depend on an index or rate. For entities that have adopted ASC 842 as of July 19, 2021, the amendment is effective for fiscal years beginning after December 15, 2021 and interim periods, with early adoption permitted. Essentially, this change will allow businesses to more faithfully represent the economics of the lease transaction and is especially relevant to the energy industry, where lease arrangements with variable payment structures are becoming more prevalent. Additionally, these revisions align the accounting guidance with prior guidance under ASC 840, as lessors were not previously required to recognize a day one loss related to these leases, given the longstanding practice of accounting for certain leases with variable payments as operating leases. In November of 2021, the FASB issued another update to the new lease guidance, ASU 2020-109, which is related to lessees that are non-public businesses, which allow companies who elect the practical expedient to utilize the risk-free rate as the discount rate for all leases at the underlying asset level rather than at the entity-wide level. For lessees that have adopted ASC 842 as of November 11th of this year, the amendment is effective for annual reporting periods beginning after December 15, 2021, and interim reporting periods beginning after December 15, 2022, with early application permitted. Companies are also required to utilize a modified retrospective transition method for adoption. This amendment will allow for more flexibility for lessees by allowing them to make this election by class of underlying asset rather than at the entity-wide level, and requires that a lessee use the rate implicit in the lease when it is readily determinable instead of a risk-free or incremental borrowing rate. Lastly, in October of 2021, the FASB issued ASU 2020-108 to address diversity in practice on how acquirers should recognize and measure revenue contracts acquired in a business combination. In summary, the amendment requires acquiring entities to apply topic ASC 606 to recognize and measure contract assets and liabilities such as deferred revenue in a business combination rather than measuring them at fair value as of the acquisition date. For public companies, the ASU is effective for fiscal years beginning after December 15, 2022, and for all other entities, the amendment is effective for fiscal years beginning after December 15, 2023, including interim periods. Early adoption is also permitted. Note that this ASU should be applied prospectively to business combinations occurring on or after the effective date. This amendment will not only better align guidance with ASC 805 and ASC 606, but it will also benefit acquirers by reducing complexities and costs in determining fair value of contract assets and liabilities, by improving consistency between acquirer and acquiree revenue reporting, and by improving post-acquisition reporting, including increasing comparability between cash flows and revenue, in addition to resolving payment term inconsistencies on a go-forward basis.
Jen, given the uptick in mergers and acquisitions activity during the year, what are we seeing in the market related to early adoption of ASU 2021-08, and what should companies consider if they decide to early adopt?
Yeah, great question, Patrick. We've seen multiple companies in the market take advantage of early adoption, but just be aware if you decide to early adopt, you will need to ensure that you consider an implementing amendment for any other acquisitions that may have occurred during the same fiscal year, which includes the interim period of application. There could also be situations that we've run into where the acquirer is unable to rely on how the acquiree applied 606, such as if the acquiree was reporting on a non-GAAP basis or cash basis, and if any changes are needed to conform with the acquirer's accounting policies. So in these cases, the acquirer should thoroughly consider the terms of the acquired contracts and make any adjustments prior to finalizing their opening balance sheet. So moving on, the staff also discussed upcoming ASUs issued in November of 2021 related to CECL, specifically around troubled debt restructuring and disclosure requirements related to gross write-offs. The first provision of the amendment relates to troubled debt restructurings by creditors that have adopted CECL, which would essentially eliminate the accounting guidance for TDRs by creditors while enhancing disclosure requirements for loan refinancings and restructurings by creditors made to borrowers experiencing financial difficulty. The provision is intended to reduce the burden on preparers in preparing TDR analyses and to enhance decision usefulness of information provided to investors through enhanced disclosures about certain amendments. Additionally, the second provision relates to disclosure requirements to present financing receivable information by year of origination, which is commonly referred to as vintage disclosures. In summary, the provision requires public business entities to disclose current period gross write-offs by year of origination for financing receivables and net investment in leases. The update is intended to provide clarity on the disclosure requirements for preparers and also improve decision usefulness of information provided to investors related to gross write-offs. The staff also discussed various forward-looking projects, including projects around accounting for goodwill, the LIBOR transition, and segment reporting disclosures. Related to goodwill impairment, the FASB staff is considering revising the level at which goodwill impairment analyses are performed, including moving to either the reportable or operating segment level from the reporting unit level under current guidance. While companies will still have to be thoughtful and perform complex analyses to determine their reportable or operating segments, this change could be beneficial to preparers as the level at which impairment is assessed will be consistent with the level of information that is presented in the financial statements, and it will likely limit or reduce the number of analyses performed. In regards to accounting for goodwill, and similar to what was noted in prior years, the FASB staff is still looking at potential options for the ongoing accounting for goodwill, such as moving to an amortization or impairment model, similar to other long-lived or intangible assets, in order to ease the burden of accounting for goodwill for preparers. Given the upcoming transition from LIBOR, the FASB voted to propose extending the sunset date under Topic 848 reference rate reform from December 31st, 2022 to December 31st, 2024. The change is meant to align the reference rate reform standard with the expected cessation date of USD LIBOR, postponed earlier this year to June 30th of 2023, and will allow companies with a significant amount of contracts to apply the relief and ease the potential burden in accounting for reference rate reform. It was also noted through company panels that some larger companies have begun preparing for the change and indicated that it has required a significant effort from their teams, including, among other things, inventorying all LIBOR contracts that would be impacted. So it's important for companies to start assessing the potential impacts early on and to ensure they're adequately prepared for when the LIBOR rate expires. Lastly, the FASB staff is currently researching options that would require additional disclosures of significant expense items that are regularly reviewed by the CODM, which was discussed earlier in the presentation. We're now going to cover various issues and insights discussed during the OCA speeches, resulting from accounting consultations and discussions with investors. Typically, the speeches represent non-authoritative GAAP and are an indication of what the SEC considers best practice. And before taking a deeper dive into the various consultation topics not discussed in other areas of the presentation, I did want to highlight a couple of key topics that were discussed at length during the speeches. As Zach discussed earlier, the OCA received several consultations related to the increase in SPAC transaction activity, including warrant accounting, earnings per share, temporary and permanent equity classification, business combination accounting, and derivatives. Additionally, the increase in transaction activity has spurred more consultations regarding materiality, specifically around the recent volume of misstatements resulting in a swing from big R restatements to little r revisions, which was also discussed earlier in our presentation. The staff also noted that a number of auditor and independence consultations increased related to the October 2021 targeted amendments to the independence requirements in Rule 201 of Regulation XX. Auditor independence will be discussed by Jason further in our presentation. And then lastly, the staff received a number of consultations related to digital asset transactions, including when digital assets represent an asset or liability of the registrant, determining the cost basis of digital assets, and revenue recognition considerations. Despite ample feedback from preparers on this topic, the panel indicated that the FASB does not currently have a project on its agenda to address the accounting for digital assets. But as the crypto market gains interest among investors, the FASB could consider this topic more closely in the future. Moving on, we're now going to cover some of the key topics discussed in the OCA speeches. The SEC staff noted that they continue to receive a steady volume of consultations around revenue recognition matters, specifically identification of performance obligations, principal versus agent conclusions, and consideration payable to a customer. The first topic that was discussed at length relates to properly identifying performance obligation in contracts with promises to provide goods and services upfront and a related service over time, and specifically whether or not that good or service upfront is considered distinct from the ongoing services. This conclusion would dictate whether or not a portion of the revenue from the contract is recognized upfront versus over time. Consultations were primarily focused on cases involving software licenses provided upfront, in addition to ongoing services such as updates or PCS, and situations in which the company is providing a smart device with SaaS software, which we've also seen frequently in our consultations with companies in the market. Generally, upfront software licenses provided to customers and ongoing services such as PCS and updates will be distinct from each other, given the fact that there is no significant modification or customization provided for these services, and the license and PCS can be transferred independently of one another. However, it is important for companies to consider the individual fact pattern and substance of the arrangement before concluding on whether or not these offerings are distinct. In regards to devices provided with ongoing software, the key consideration is to determine whether or not the software license is a component of a device that is integral to the functionality of the good, and whether the software and device only together produce the essential functionality of the device. If it is concluded that the software is essential, these offerings would generally be considered a combined performance obligation. An example of this would be a smartphone and the related operating system software, as the customer would not purchase the operating system software without the device, and the smartphone cannot perform the key functions without the software itself. Additionally, the staff also noted consultations related to principal versus agent considerations, where the company is taking a good or service from a third party and integrating that good or service into its own offerings, which it then sells to an end user. In these cases, it's important to consider the complexity and significance of the integration services and whether or not the company is taking control of third-party inputs. If it's concluded that a significant integration service is being performed, the services and third-party inputs would generally be considered a combined performance obligation under the guidance. And while we're on the topic of principal versus agent, the staff also indicated that they received multiple consultations around the general principal versus agent conclusions, primarily from technology businesses. The staff discussed the importance of beginning with a detailed understanding of the fact pattern and substance of the arrangement without preconceived notions around the company offerings and customers. So essentially, they encourage businesses to follow the guidance step by step versus just jumping to a conclusion based on what they perceive the business to be offering and its relationship to customers and third parties. The staff also reminded preparers that the indicators of control in the principal versus agent analysis are not a replacement for the assessment of the definition of control. In other words, the principal versus agent analysis indicators are not a checklist to be assessed without considering how and the extent to which the facts around the indicators actually support that control assessment. The staff also indicated that they have received consultations around consideration payable to a customer, specifically when companies have concluded they are acting as an agent, as there are complexities associated with determining the nature of the agency promise and the related customers. An example discussed was related to a situation in which a platform company was acting as the seller's agent with an end user buying from the seller that is not a customer of the company. Certain incentives were paid to that end user, and the company accounted for those incentives as a marketing expense, which the staff did not object to, but did note that they have objected to this conclusion in other fact patterns. The staff also highlighted the importance of determining whether the company has a single customer or multiple customers in these contracts. In situations where the company has a single customer, it is important to consider whether the company has an explicit or implicit promise to provide incentives to the end user on the seller's behalf, or if the company is making an in-substance price concession to the seller for the agency service. This will inform whether or not the consideration paid is truly paid on behalf of the company's customer, i.e. the seller, and recorded as a reduction to revenue, or whether the consideration should be accounted for as a marketing expense. And lastly, the staff received various consultations from companies regarding the lease standard, primarily related to scope, transition, and accounting for certain lesser and lessee costs. It's important to note that ASC 842 still remains top of mind for the FASB as they're continuing to actively consider improvements and clarifications to the standard, given the big push for private companies to adopt. We've had multiple conversations with various private companies, given the upcoming transition deadline, as there is a lot to consider from an operational and a technical perspective. Companies that have not yet adopted should ensure they are beginning to assess impacts of the standard early on and plan for the upcoming transition. And with that, I will transition it back to Patrick for another polling question.
Great, thanks, Jen. A lot there to cover, and definitely appreciate it. So with that, I'm going to polling question 3. With the the discussion of ESG out there, wanted to see what stage of ESG reporting would you categorize your company? A, nothing outside of the required 10K disclosures or financial statement disclosures. B, starting to plan for our ESG reporting program. C, doing sustainability reporting on company website. D, issue an ongoing ESG report that includes assurance. And E, not applicable. So with that, Jason, wanted to get your thought as the audience responds to the polling question. Given the increased discussion around ESG, can you give us an idea of how much ESG was a focus at the conference?
Yeah, thanks, Patrick. And yes, I mean, I would say ESG was one of the most, if not the most popular theme at the conference. Just to give some reference, in years past, ESG may have been a 30-minute session. However, in this year's conference, it had 2 hour-long sessions devoted strictly to ESG, and there was also a talking point in multiple of the other sessions. Some of the 2 sessions that were specific to ESG included a panel with IFRS and AICPA executives, where they discussed updates in the standard setting process. And then the other session included a panel of controllers, where they discussed how their companies are addressing the ESG reporting requirements and preparing for the new standards.
Great, and got our results. It seems like, just like most of us, there's not a lot of, everybody's kind of starting to be new to the ESG and the required disclosures and what to expect in the future. And with that, I'll hand that off to Jason to take us through the hot topics.
Great, so yeah, this last section covers 3 additional topics that were heavily discussed at the conference, including ESG reporting, the evolution of data and technology, and the related cybersecurity risks, and then an update in the auditor independence guidance. So for ESG reporting, how far has ESG reporting come in the last decade? So in 2010, the SEC issued the climate change guidance, which required companies to report, among other things, the impact of pending or existing climate change related legislation and the indirect consequences of climate change regulation and the physical impacts that climate change is having on the operations of the business. This guidance, of course, was met with a low level of interest from both investors and stakeholders. Recently, within the past few years, we have seen a drastic increase in the investor demand for ESG-related information. An example of the increase seen is when Larry Fink, the CEO of BlackRock, said that this year we are asking the companies we invest in to publish a disclosure in line with industry-specific FASB guidance by year-end and disclose climate-related risks in line with the TCFD's recommendations. This increase in investor demand has consequently caused standard setters to focus on generating a set of global standards. Currently, we do not have one set of standards, but rather have a patchwork of 5 commonly used frameworks tailored to each company's stakeholder interest. This has led to the creation of the International Sustainability Standards Board, which is otherwise known as the ISSB, whose mission is to formulate a baseline for sustainability reporting and one global set of standards. And looking ahead, the SEC and ISSB are committed to staying aligned as the global standards are created. However, they understand that each region will have different investor demands, and there will need to be slight differences in the reporting requirements by region. The ISSB has signaled that it intends to use the Task Force for Climate-Related Financial Disclosure, or the TCFD framework, as a basis for their global framework. The TCFD's current framework for ESG reporting categorizes disclosures into 4 risk categories: governance, strategy, risk management, and then metrics and targets. Therefore, we would expect the ISSB to have categories similar to these. Lastly, as standards are being finalized and disclosures required, this also requires a higher level of assurance to be needed around ESG reporting. So what is everyone saying about ESG reporting? The SEC staff reminded the audience they issued a comment letter last year related to ESG disclosures. Some of the comments included providing a reason as to why a company's CSR report would have more expansive disclosures than they would have disclosed in their SEC filings, the need to disclose material litigation risks such as policy or regulatory changes and their potential impact, and the need to quantify any material increases in compliance costs related to climate change. As discussed earlier, ESG had 2 specific sessions at the conference, with the second session including a panel of controllers whose companies had begun implementing an ESG framework and reporting process. This panel was very informative as to what preparers are currently saying about ESG requirements and the related difficulties experienced. The panel mentioned the need to focus on the facts and information that your investors and stakeholders care about and eliminate the unnecessary data. Ask yourself, what are investors focusing on in today's environment and in the industry? What do our customers care about? The panel emphasized the need to work cross-functionally as well within your corporation, as ESG will require more than just the accounting or finance team. Most of the ESG related data, of course, is non-financial data and will be housed in other operating departments, and thus, of course, other people must be involved from the business. Like being required to report the synergies as well as dyssynergies in a pro forma financial statement, the panel also stated the need to report the bad data with the good data. Be consistent in the metrics you report if there are still the key metrics investors find relevant for your business. This will lead to reporting less than desirable information at times, of course. Home Depot's controller said it best when discussing the various ESG metrics, when he essentially said, how do we tie all this stuff out? Which simply emphasized the need to have controls and a proper governance framework over ESG reporting that are similar to an ICFR framework. What systems does the data come from, and are there proper ITGCs in place around that system? This is typically why the accounting team drives the ESG related reporting. However, some companies are creating an ESG task force to manage the ESG process. Typically, the task force will include either the controller or someone from the internal audit team to help in understanding the needs for a proper internal control framework. Lastly, the controllers panel concluded their session by explaining that the ESG reporting requirements are not just for those industries that significantly impact the environment, like oil and gas, but these are relevant for every company as we all play a role and have an impact on ESG. Another topic discussed at the conference was related to the evolution of data and technology in today's environment. Tracy Golden, the immediate past chair of the AICPA, mentioned that disruption in the economy leads to innovation, which in today's environment has accelerated the adoption of cloud-based technology by 4 years. The senior associate chief accountant also said that registrants will need to consider how changes in the use of technology in the financial reporting process impact their internal controls and evaluate whether any changes in internal controls may require disclosure in accordance with 308C. The SEC staff also emphasized the evolution of cybersecurity and how it is crucial to evaluate its impact and the related risks on financial statements and related disclosures. They continue to explain the need to have a robust analysis on whether cybersecurity risk factors are key risk factors to your business and thus should be identified as such in your disclosures. Over the past year, we have seen a 33% increase in ransomware attacks, and these attacks have evolved from trying to sell credit card data for pennies to holding ransom the data of a corporation. As most of you, I'm sure, remember, an example of this recently happened with Colonial Pipeline in May of 2021, in which they had a ransomware attack and the hackers demanded $5 million to be paid in exchange for the stolen data. The staff discussed the importance of determining whether a cybersecurity breach impacts an entity's financial reporting process and ensuring that each breach is thoroughly evaluated both quantitatively and qualitatively for materiality. Julie Lindsay, CEO of Center for Audit Quality, said the SEC continues to emphasize their focus on ESG and cybersecurity reporting and disclosures, and there will continue to be an increased focus on cybersecurity-related ICFR frameworks. The last topic we will touch on today is regarding auditor independence. Auditor independence evaluations has been a focal point in recent years by the SEC due to the uptick in capital market activity, which has led to several independence violations. In a recent Wall Street Journal article that discussed capital market trends, it mentions that the pipeline is strong for 2022 IPOs, with more than 900 private companies being worth $1 billion or more, which is going to put even more of a focus on independence. The Deputy Chief Accountant highlighted the amendments to Rule 201 of Regulation SX were issued in October 2020 and had the intention of modernizing the SEC's independence requirements. A key adjustment as a result of the amendments is related to the requirements within the look-back period. Before the amendments, U.S. first-time filers had to comply with all aspects of the SEC's independence rules for all periods presented, which is key, all periods, in an IPO or SPAC transaction. As a result of the amendments, only the most recent fiscal year presented is required to comply with all aspects of the SEC's independence rules, with the remaining look-back periods or remaining periods presented be in compliance with previously applicable independence standards. The general independence standard within Rule 201B is required in look-back periods and includes guiding principles as to whether a relationship or service either creates a conflicting or mutual interest between accountant and audit client, or places the accountant in a position to audit their own work or act as management of the client. The SEC staff shared an example of an independence violation in which the financial statements of a private company merging with a SPAC were required in a registration statement for fiscal years 21 and 20. The private company's auditor prepared the 2020 tax provision during 2021. So the service was actually performed in 2021. The SEC staff noted that the auditor violated the independence standards in both periods by first acting as management in 2021, which is the year the tax provision services were performed, and then by auditing its own work for the 2020 audit. Lastly, of course, the SEC reminded the audience that auditor independence is not the sole responsibility of the auditors, but it's a shared responsibility between registrants, audit committees, and auditors. With that said, I'll pass it back to you, Patrick, for our last polling question.
Sure, great, thanks, Jason. So last polling question, just wanted to get a sense check from the audience of going into the 2021 year-end financial reporting cycle. What do they expect the most challenging topics to be? A, application of new SEC guidance like revised MD&A. B, application of accounting standards. C, satisfying new investor demands for increased ESG reporting. Or D, other. And as we're waiting on the audience to reply to the polling question, we did have one question come in on ESG, as Jason was discussing. What's your advice for companies as they start preparing for ESG reporting? I think, looking at, that could be a webinar topic in and of itself for sure, but certainly I think a place to start with the breadth that there is there, you could look at that second slide that Jason spoke to, and really the right-hand side of that page in terms of what the preparers were saying in terms of really identifying what's key to your stakeholders, what they care about, what's the information that the board, the stakeholders, what do they really care about, and focusing on that. And then also getting familiar with the standards, the different frameworks out there, what's most applicable. You know, we'll definitely reach out on, you know, after the conference and you know, for further follow-up there. Another question that came in was, and maybe Zach, you can take this one, when the SEC discussed having a more objective view on materiality, was there any discussion around a specific quantitative measure such as the 5% of pre-tax income rule? Did they cite anything specific?
Yeah, the SEC generally reminds preparers to look at the totality of information, both quantitative and qualitative. You know, they're not going to sign up for any quantitative bright lines, but in practice, for folks on the phone, you've got to have a starting point somewhere, and generally that is 5% of pre-tax, 1% of assets, or 2.5% of a non-GAAP measure as a starting point. Isn't the ending point, but you know, the SEC generally doesn't stick to or commit to specific numbers, but rather encourages preparers to look at all the information when making a decision around materiality.
Great, thanks, Zach. And with that, I think we're going to wrap up the day. Wanted to highlight the additional resources, some related thought leadership out on the Riveron website. And obviously, feel free to reach out to any one of our experts that were on the line today. Happy to discuss any further follow-ups or specific circumstances and talk through anything that may have caught your attention as we walk through the content. Appreciate everyone's time today and have a great afternoon.